Here we go. And let's see if we're live yet. Ladies and gentlemen, we are live, the 11th episode of the TradingView show. And today, I am thrilled to be joined by Stewart Taylor. I met Stewart Taylor on TradingView. He has been operating and creating content from the official CMT Association account on TradingView. And Stewart has a very diverse background in markets, including running his own firm, working across the institutional landscape, and a lot more. So I think this is a great guest to have on the show. And if you are hopping in, whether in podcast format, video format, live stream format, expect to hear a lot about the long journey within markets, and especially with some insights into the institutional side and what it is like working in a large firm managing a lot of money with various colleagues, clients, and business associates. So, Stuart, great to have you on the show. I think there's no better way to get started than for you to. You have a great background in markets. I just want to kick my feet up and let you introduce yourself and tell us about your journey.
Sure. Thanks for having me. Yeah, as Stefan mentioned, I have been trying to give back a bit by writing for the CMT, putting up ideas, under the CMT headline or banner, and just trying to give back. I mean, technical analysis has been really good for me. I started in the industry in the late 70s, early 80s, and I retired in 2020. So I've been retired 2 or 3 years. Frankly, I'm not trading a lot anymore. Only if I see something I think is an extraordinarily good opportunity, I'll take a shot at it. But mostly, I'm just clipping coupons now and hanging out, doing a little bit of this and that, and enjoying the grandkids and such. But like Stefan said, I've been trading a long time, and hopefully I can share a little bit. So I started the business. I've always been on the fixed income side as opposed to the equity. And as a fixed income trader, trade a lot of futures, a lot of options on futures, of course, a lot of cash fixed income, and a lot of derivatives. My exposure on the equity side, particularly institutional, has been, it hasn't been extensive. But on the fixed income side, I've done about everything from I was a portfolio manager of the inflation fund at Eaton Vance. That's about $1 billion fund now. I helped start that fund, ran it for almost 15 years before I left. Been the senior strategist in the fixed income department, allocating between mortgages, corporates, uh, helping with duration calls and so on and so forth. I started there as the senior trader. I was hired from my own research firm that I ran for around a decade after I left the institutional sell side, where I sold my daily research ideas. It was heavy timing, using a lot of option strategies, sold it to mortgage banks, hedge funds, dealer trading desks, published daily ideas, trading levels, things of that nature. And, I had quite a large subscriber base, but, that got to be really, really old. And the Eaton Vance opportunity came along to actually move to the buy side. And I took it. Before I did my research business, I was an institutional sell side broker, started at a very small firm in Little Rock, right during the uh, decade when inflation was falling, rates were falling, and uh, the big problem. And I noticed it right away. I knew very, very little about investments or anything, but all of our sales managers were fundamentally based, and they always thought markets were going up. And of course they were never right. That is a market, though, in the 70s where rates were falling and falling consistently, where everybody could be right. But I just came to the uh, idea that there had to be something more than just this blind investing on these fundamental ideas. And So after getting in the business, after a couple of years, I moved to Shearson Lehman, and at that point, I actually aligned myself with a team that did technical analysis. And once I discovered technical analysis, I fell in love with it. It was a great way to manage my accounts and help them. And at that time, my accounts were mostly mortgage bankers, right? And mortgage bankers, they originate a mortgage, it goes in a pipeline, and it's highly optional, right? If rates fall a lot, those mortgages don't close. And if they've hedged them, they just have a loss with no offset. And if rates fall or rates rise, obviously that loan is going to close and they have a lot of exposure. So we developed a lot of ways to hedge that pipeline exposure. I discovered that technical timing was an excellent way to do that. And again, after a number of years of doing that, and we were literally trading hundreds of millions of dollars worth of TBA mortgages, futures, and options on futures, I decided to move home, start my research business. And as part of the research business, of course, I traded fairly extensively for myself. Everything from 1 and 5 minute bond future charts to, that was most of it. A lot of options, things like that. But, I just found, that I wasn't suited for that. I was good at it and always made money, but it just wore me out. I mean, I was telling Stefan earlier that it's just life spent living and dying by the tick. And for some guys, that works, but for me, it didn't. So I started focusing more on longer term trading. Of course, the research ideas, asset allocation, when to move from treasuries to corporates, corporates to mortgages, mortgages to CMBS, how to allocate, and moved away from mortgage banking. Did that for a number of years. And Eaton Vance, they hired me. They were one of my clients. And the managing director of their investment grade fixed income followed me for quite a long time, and they offered me a job. And so I ended up in Boston in an institutional environment. Again, my sell side experience was institutional. Almost 100%, 95% of my clients on the research side were institutional, and now I got to experience the buy side institutional. So kind of in a nutshell, that's it. Hired as to upgrade the trading desk at Eaton Vance. Did that for a couple of years, but I think they decided my value really was more as a strategist and a timer, a portfolio manager as opposed to the trade desk. I still had some responsibilities there, but they were relatively minor from after the first 2 to 3 years. So what's next, Stefan?
So that background, I think, is fantastic for a lot of listeners, especially you starting your own firm, because I have noticed, especially meeting people on TradingView and now like yourself, that a lot of people are entrepreneurs in markets. They often are trying to build their own trading fund or long-term investing fund or research firm. And so I think that's really interesting to hear more about, that you started your own research firm and were able to sell it. And what sort of, are there any tips for people who are trying to start their own research firm that you would offer them, or any insights? Do you think is it too competitive now and too crowded? Were you early to sort of that business? What are your thoughts on that?
Well, it's competitive and crowded, but it's always been the case where good research wins out, right? There's a lot of research out there, but frankly, most of it's trash, right? I mean, I don't think most of the people offering research, they haven't had practical experience trading, and it shows, in the suggestions, or they weasel. There's nothing worse than a weasel in this business, right? Well, I'm long at blah blah blah, and yet you never saw a ticket punched or anything of that nature. So there's a lot of bad analysis out there, and frankly, you've got to do something to differentiate yourself, right? everybody knows what an RSI is, or a moving average, or, you better have something more. I mean, in my case, I always viewed it as kind of think of a Venn diagram with three circles, right? One of the circles has technical analysis in it, the other has fundamentals, and the third one is value, right? And so what I did to differentiate myself is I applied technical analysis to a lot of fundamental kind of indicators, and tried to build context with the fundamental, and that provided a why to buy, right? Then you use technical analysis to tell you when to buy or when to sell, as the case may be. And then, of course, the final leg is value. So within that universe of things that I might buy and sell, where's the greatest value? And again, using spread analysis and various things, I tried to combine the three, right? So I could tell them, look, I have this fundamental opinion, right? But we all know that fundamentally, you can have exactly the right opinion and be exactly wrong about the markets, right? Markets aren't always fundamentally driven. A lot of times they're emotionally driven. So, you combine the technical with the fundamental, and then what to buy, and you try and place trades in the intersection of those three. And that's what gives you the highest, the most consistency. And you do that over and over and over again. And just the weight of being, look, you're not always going to be right. Fact is, I know a lot of really good traders that are wrong more than they're right. But, you utilize good risk management, discipline in what you do, and it will probably work out. In terms of how to get started, it's really different these days. I mean, when I started out with a daily fax product. You can't appreciate how hard it was to fax 100 clients, um, each morning, and had to buy special fax cards. At first, it was just a tremendous hassle. When I moved home, even getting data to the house, I put up a satellite dish in the backyard. It was hugely expensive, very, very difficult to do. Now it's, click on TradingView and you can get probably 80% of the assets in the world, right? Data is, maybe it's still a little bit expensive, but it's very inexpensive compared to when I started, we were, of course, drawing charts by hand. I had some charts that were folded over so many times, they were probably 20, 30 yards long, where you chart every tick of the T-bond contract, because that's what you're involved in trading every day, right? And I was always loved Wyckoff. Early on, I used some Elliott stuff, but there's just something to be learned from tracking these things, and writing them down and learning about the ebb and flow, things you just miss, I think, when you're staring at a computer screen. That said, I don't chart by hand anymore and haven't for a couple of decades now, but anyway, uh, so yeah, you've got to be different, you've got to differentiate, you've got to be institutional guys. If that's who you're trying to sell to, they don't have time for spiels, right? You need to get right to the point, tell them what you think ought to be done, right up top, right? What the bottom line is, and then you can justify it down below if you want. The justification is important, particularly for new clients, right? Because they don't know you and prospects. But once the clientele gets to know you, get to know how you trade, they probably won't even get that far. They're looking for that bottom line. And then if they're really, really interested, they'll go down below and kind of figure out the rationale for the trade and such. Did I get there at all?
Oh, it's perfect. And actually, one thing I wanted to comment on. So, it is a competitive business. Starting your own firm and trading or investing, or your own research firm or fund, anything under that umbrella. And you mentioned about how a lot of it is potentially just wrong and crap. And then I was listening to you talk about how you were actually drawing out charts at a certain point, and you had to install an antenna before data was so easily accessible. Do you think that a lot of like what do you think someone who's trying to start their business now should do to gain that experience? Do you think they should go try to work for a big firm first, or should they put their calls out publicly? What's how do you think you get the attention of an institutional investor if you're just a average trader who's
Yeah,
started their
you're
own
not.
firm? You're not, yeah.
You're probably not. I mean,
Wow. Yeah.
there's look, you've got this pipeline when you're sitting in an institutional seat. You've got this pipeline of crap coming at you all the time, and learning how to separate the wheat from the chaff is really a difficult thing. So you tend to just tune most of it out and focus on a few things. So that means it's really, really hard to break in. But I think if I were starting today, make sure you know your stuff. Make sure you spend some extra time. Gosh, I see so many things in like Editor's Choice and other places. Not a knock on Editor's Choice. I see it everywhere I kind of look. Where I think if you read my stuff, it's pretty clear about what I'm suggesting and how you get there. I think a lot of people don't write very well. I think it's really worth your time to maybe take a class in technical writing or business writing or something like that. Because you have to be clear and you've got to get through the noise really quickly, or you're not ever going to get traction. Trades have to be doable. They have to, if you think about, the fixed income market where bid offer spreads are quite wide, you're probably looking at trade duration of weeks and months and quarters, right? You have to understand the client you're trying to sell to. It's very, very different than selling to a client that wants to know a day trade idea or a quick scalp idea, right? So, yeah.
And you mentioned about the forms of.
And I'm not saying it's impossible. It's definitely possible. Write well, be consistent in your ideas, how you present them. And then it takes a lot of hard work to break through the fog of what these guys are going through every day, right? Um, when I put in a plug, I also don't think I would stay. The other thing is be a chart dog. My God, how do you replace building charts by hand? You look at thousands of charts. And in a lot of my comments, I write about this. You look at thousands of charts and you begin to develop a sense of what's important, what's not important. I'm a big believer that markets only generate most of everything that happens in markets is noise, right? And people that are forced to write and forced to present trade ideas are trying to comment on this noise every day, all the time. When really, if you're trading on a weekly chart, there are only 3 to 4 times a year when what the chart does is actually that meaningful. The rest of the time, it's either trending or consolidating, and that's fine. But you're really interested in those 2 to 3 times a year where you are at a confluence of support or resistance, timings right, and what's happening on the bar chart looks right, and those kinds of things. And the only way you get that, you don't get that. Look, you're never going to be a very good trader if you're just taking a trade that somebody publishes and says, I'm long gold here because of this Elliott wave candle, right? You're not going to have the discipline or the understanding to stick with it when you need to stick with it. It's just not very workable, right? The way you develop that is you come in at after work, in the evenings. This is assuming you're not already a professional. You open up TradingView and you start, scrolling through charts, perspectives, 5 minute, 30 minute, 60 minute, hourly, daily, weekly, monthly, looking at patterns, looking at volume, looking at the interaction. And after a while, you'll just start seeing these things. I think most of what I do now, I can evaluate most charts in seconds. and see if that's something that I'm interested in exploring more deeply, or just on to the next thing, right? And that's what it takes. You've got to be a chart dog. You've got to be devoted to this thing. And if you're going to do it half-assed or part-time, um, there's just easier things to do.
Wow, perfectly said. So well said that Sinbad the Trader sent us 100 TradingView coins and said, "Good discussion." So Stuart, keep it going because you're. I like the
Thanks,
term.
Matt.
I like the term chart dog too. I haven't heard that before. Being a chart dog, essentially, being very tenacious with your consumption of charts, right? And question on that: how many years do you think it takes to be considered an expert in charting in markets and price action? Would you say it's over five, or what comes to
I
mind?
think so, but again, it's very dependent upon you as a person, and it just takes a while, and so I'll go into another thing I believe about trading, and just my how I got there finally. And when I was pretty early in the business, I think during the 87 crash, right? 85, 86, 87. At that time, I had really gotten heavily into, I loved Wyckoff, and I combined it with Elliott Wave. And I spent a lot of time with Elliott accounts and so on and so forth. And I really made some great calls on both fixed income and at this point I was just working at a small broker dealer. I would send my daily, 3 days a week. I would send out commentary about the market, short term, long term, and I made this great call that probably really got me started in my career in a big way, using mostly Elliott, right? And my head got bigger and bigger and bigger, as it would do for a young guy. Um, and as my head got bigger and I decided my shit didn't stink, basically, I added more and more and more, added this oscillator, that oscillator. At that time, I was uh, trading pretty heavily. Even though I worked at a small broker dealer, I could still trade for myself. And listen, the more stuff I added to my process, the worse my process became, right? I finally got to the point I just literally couldn't seem to be able to buy a trade. I mean, it was horrible, you know. And finally one morning I came in, I just blown through more P&L that week, the prior week, and came in on a Monday morning. I said, I can't do it this way, and I started throwing stuff out and got simpler and simpler and simpler. And the more simple I got, the better my trading became again. Until finally I'm down to a bar chart. I typically use one oscillator. Uh, uh, I don't really care about moving averages. I use Fibonacci a lot. I don't use Elliott very much. I mean, I traded it extensively. I just think Elliott's not very simple, right? There are too many ifs, buts, exceptions, extensions. If I can look at a chart and say 1, 2, 3, 4, 5 that quickly, it's probably usable. But it has to be quickly identifiable, right? And and it has to be in proportion, or else I'm not interested. It's not really a count. And anytime I'm adding X's or Y's, the guys I know that use Elliott, and I know some, that have used it very effectively over the years, they use it with a heavy dose of risk management and discipline, right? Um, and I think that's true of everything. Look, I don't know, most of you are probably too young to ever remember Arch Crawford, but Arch Crawford had a business, a trading business, where he traded uh, basically astrology, or astronomical, Mars going retrograde, and this lunar cycle, this, that. But what I discovered about Arch over cocktails one night is his risk management process was next to none. And what I found out over the years, there's lots of ways to skin this cat, if you've got good risk management. I've but so anyway, I've kind of got away from the subject. But look, on top of being a chart dog, you've got to understand risk. You've got to understand how to manage risk. You've got to live to play another day, day after day after day. That means you can't let individual trades beat you up. Point being, once I simplified everything, I've got a bar chart in front of me. I've got one oscillator. I might go look at another one or two for confirmation, but it's very, very simple. I'm looking for patterns, looking for confluences of support resistance, things like that. Where do you want to go next, man?
Well, actually, what you just said about bar charts, and I think you and I have discussed this before, and I think it's so interesting because of the way candlesticks have taken off in the charting landscape. And to confirm, so when you were working at some of these large firms, were people using bars and candlesticks, or was it mostly line charts? Has this been in the industry for a long time? And why do you think can't you know? There's a lot into this question, but I guess I'm looking for some insight into bars and candlesticks, and if let's say we go walk into a large firm tomorrow and we see their screens open, are they looking at bars or candlesticks?
I would say the answer is yes. Or line charts. Look, I don't have anything against candles. You see, in about half the things I have candles up, but they're in essence the same chart. And if you stare at bar charts long enough, I think candles are a really nice shortcut, particularly for young traders who are trying to just visualizing the patterns, the individual bars. I look at a chart now, a bar chart, I basically see a candle chart, uh, just because I've trained my eye that way for so many years. So I have zero problem if somebody wants to focus on candles. They're great.
I didn't get that. Could you try again?
My watch is talking to me. What a world. Um,
I'm not sure I understand.
Si- Siri thinks that you mentioned her name, but it's very interesting to me because candlesticks have really taken off. I think candlesticks could be 90% of the charts I see now. But you talk about bars a lot, and it sounds to me like let's say when you were getting started in markets, and this was happening with everyone. You had to draw those bars out on paper, which I just find that so fascinating, just of how that's changed. We've gone from bars to candlesticks.
yeah, and again, charting candlelight. I've had guys come into the comments in the CMT feed. I'll publish something, I'll do it in bars, and just uh, be derided over the fact I've used bars rather than candles. And to me, it's pretty silly. I mean, they're the same damn thing, you know. So it's okay if you choose to use bars. Good on you. And again, I do think they're a decent shortcut uh, from just a regular bar. I mean, I think the patterns probably stand out a little bit better if particularly if you're early in your career, those kinds of things. Um, and yeah, I think it's true. I think most young guys use bar charts. Um, you know, One thing I don't see a lot of that is probably underutilized, point and figure charts. Again, for years I kept point and figure charts of the bond contracts, both on a continuation and an individual contract basis. Uh, but learning how to measure accumulation and distribution and projecting price objectives is kind of a lost art. Uh, but point and figure is, something you should probably know. Now, when you walk onto most floors, I don't think you're going to see very many charts. Maybe on the trading desks, right? But you're not going to see them in most offices. There are always a few people that use them, and it's obviously for people that have to make execution choices. It's a big deal, but for most portfolio managers sitting in their office, they're probably not going to have a chart up other than maybe just a quick look at it. Yeah. So,
And how about, and that's interesting that you mentioned that. And I know a lot of people listening probably,
and
yeah.
by the way, that's going to vary from place to place, right? I mean, like Fidelity has a group of dedicated technicians who are assigned teams of PMs that they pitch trades to, and there it becomes even at Eaton Vance, there were individual portfolio managers that use this, but you know, a lot of times too, you've got to justify positions to consultants and to your board, right? You've probably got to go at least once a year, justify your trading for that year, how you did it. They're not going to embrace the idea that you did that technically. So I always viewed fundamentals as building a framework or a context for my technical trades, if that makes sense.
It does. And there's a great question in the chat actually about your use of fundamentals. But before we get to that, I want to quickly comment on the aspect of, different portfolio managers using different strategies, and you met the fund that you mentioned you worked at, I think close to $1 billion now under management, or more than $1 billion under management now. What?
Yeah, my group. So Eaton Vance is and they were just recently purchased by Morgan Stanley, but we had about 500 billion under management. The group I worked in, we managed about, depending on how you measure, including, probably 10, maybe 15 billion of that under direct management, that I was a part of. It's divided between equity, global fixed income, and of course you come together as groups and talk about allocation and so on and so forth, and the economy, those kinds of ideas. But
That was
yeah.
I'll say that was exactly going to be my question, which I think is interesting. Is what is that daily research process like? Is most of your time spent analyzing markets, or is it placing trades, or is it just discussing it with other people at the firm? Walk us through what that's like.
Well, it depends on what's going on in the markets, obviously. Um, when things are melting down, it's all hands on deck and a lot of stand up worried meetings around, stand up table someplace. But my typical day would be, and again, remember in a fund, you're probably not trading all the time, right? Um, but my typical day would be, I've always liked to analyze early in the morning before markets open. So I would get in. I would probably, particularly toward the end, where Bloomberg had all these tremendous API link things. So I would set up chart packages, whether it's commodities, equities, fundamental, whatever. I would generate those chart packages and spend my mornings looking. I would say I would look at hundreds of charts a day, almost every day. Um, a lot of it was automated. A lot of it doesn't take that much time. A lot of it's between meetings, but you not only have meetings about, or also you have opinions about how to manage your fund. You got to communicate that to traders. A lot of days there's not much to do. There's marketing, right? So you spend a lot of your time talking to outside investors. Um, they're going to be very cognizant. It's not as easy as just making a bet. You've got to make bets within the confines of, if you have too much tracking error, if you look too different than, say, an index, you might be investing against. And so your tracking error skews wildly all the time. Even if you are producing a lot of alpha, it's going to generate a ton of questions and a lot of hesitation among the better investors. So, there's always compliance, and it's not an easy industry by any means, at least in the places where it's done well and you generally worry about the money you manage, which is generally, it's pooled money from everything from small investors to pension funds to public unions and so on and so forth. So your fiduciary responsibility is really, it's a compelling thing, right? You have to pay attention to it, which means that for most of us, at least at the firm I worked on, you're not gunslinging. You're trying to be thoughtful, trying to find situations that make sense. You know, and again, for me, a lot of it was moving between asset classes and changing. And then, of course, a lot of the alpha is just, I think my thing is duration. What are rates likely to do? And that just, since everything is rate based, that's the basis. Everything else is on trade. And by the way, anyone that wants to know a little bit about credit spreads, which I think is a really important thing to kind of understand for equity, commodity, for everything, right? Under the CMT banner, I did do, I think this was mid-year last year, I wrote several pieces on how to evaluate credit spreads and the pitfalls of looking at like HYG and the investment grade ETFs and why they're driven more by rates. But it's an important thing to understand. And I wrote a whole series of 2 or 3 pieces on it that cover, a couple of thousand words. I think that I think do a good job. What else, Steve?
So,
About
so I'll
Stefan?
say it's interesting that at an institutional fund too, you bring up a good point that it's not all just you're not always just placing trades and slinging money around and making bets and everyone's getting rich. There is that fiduciary duty aspect, which is the real deal, very serious, super important. Like you said, unions might be giving you money, education funds might be giving you money, so that fiduciary duty is essential to remember that you are after all watching after these types of fun this type of money. So I liked hearing that because I think people forget that that's a very serious thing. It's probably better to go slow in those situations and make sure everything's planned and calculated well. One topic I wanted to ask you about too is you mentioned about outperforming some of the indexes, which is, for me, I understand that. I think some of the listeners might be interested to know more exactly what that means because ultimately that's how you're graded, right? At institutional funds, if you're outperforming certain indexes, that's your alpha, I suppose.
Yeah, yeah. I mean, so when I started, of course, I was on a absolute return basis in my own trading and what I was doing for my clients. But when I went to fund world, yeah, everyone's got a benchmark. If you're trading, if your benchmark's the S&P 500, in my case, most of my benchmarks were fixed income benchmarks, like the uh, uh, 1 to 10 intermediate government, you know. So you're measured against those things, and you either underperform it or overperform it, right? And you do that through allocation and changes in duration. But the tricky part gets to be like you can't concentrate your bets too heavily, right? Because when the consultants come in and they see that you might produce alpha, but it better be have something to do with how that market moves, um, as opposed to these wild bets where you don't track your index very well. You're not gonna accrue very many assets in that, if you're doing that. Guys like Bill Miller's a guy that a lot of time is brought up as this paragon of investment. But yet during the great financial crisis, the tide went out. Bill Miller, Kathy Wood, underperformed tremendously, right? Because turns out for years and years he had been overweighting financials, prior to the financial crisis. He overweighted them for years and years, and he got crushed, even at the fund level, when the tide went out. And of course, luckily uh, the bailouts occurred, and Bill got back to, he's famous again, and performances, but most prudent people, they just don't do that. I mean, um, yeah, your responsibility is pretty great. And from my experience, most people in this industry, uh, they're kind of consumed by that. You worry about your investors. This isn't like I don't know. One of the things that drives me, I'm just rambling, so stop me when you need to.
No, this is great, and I do want to. I've got two questions from the users that I want to bring up, but keep going before.
Well, I'll just say, 2 points. One, it drives me nuts when people like consider poker playing like part of, analogous to trading, right? I think they're very, very different. Trading, to me, it's not so much gunslinger. It's more sober, thoughtful. Um, Poker is just an excuse to drink whiskey and smoke cigars and have some fun. So I hate it when that happens. The other thing I was just going to say is, as a trader, as a PM, any of these things, Dunning-Kruger is a real thing. We all overestimate, our abilities and what we know and such. You better be really, really humble if you're going to be good at this. I mean, above my trading desk, and I've had this same, uh, it's Einstein and Mo, right? I've had that above my trading desk for nearly 40 years, right? Because you never know from day to day which of those two guys you're going to be. And you better get your ego out of it. You better, pay attention to whatever narrative you may be trapped in. Um, and you've got to be willing to change your opinion, strong opinions, loosely held kind of thing. Um, you're going to be wrong a lot. I used to teach my young traders, look, you know, I don't really want to hear I want to know when trades go right. I want to know when they go wrong. But what's the Kipling, right? Treat triumph and disaster just the same. If you find yourself yelling and screaming when you have a winning trade, you should just be flat, right? I mean, a trade's a trade. If you don't celebrate too hard when you're right, you don't have to apologize nearly as hard when you're finally wrong. So anyway, let's go on to the question. I guess.
I love the pictures of Mo and Einstein, and I can relate to that in my trading experience. Yeah, you never know which one you're going to be, but you will definitely experience feelings of both at certain points in this career. So I love that. That was really cool for you to show us those two pictures that you have hanging above your desk, and I found that both funny but also very almost educational because it's so true, and to see the actual images was pretty enlightening for me. So one of the questions that comes up from user Rach Dev, and this question was asked about 20 minutes ago or so. It's when we were talking briefly about fundamentals, and the question is: fundamental analysis is very vast. What are the specific things that you like to check? Oh, Stewart, I think we lost you for some reason. Yeah, your audio cut out. Oh, yeah, I see. You were muted by accident.
That's funny. I didn't touch anything or do anything. It just muted itself.
Well,
Crazy.
the good news is you're back now. So
Yeah.
yeah, start from the top again.
Yeah. So I did a series again, I think at the end of last year on using one of the fundamental things I do is I like to take 50 or 60 different markets, and at times it's been more, but I chart them all in a momentum matrix, right? With commodities, rates, equity sectors, so on and so forth. And I try and visualize the business cycle through those charts. It might be a good thing. That might give you a good starting point. And I go through in the series how to develop those charts and how to view them and how to evaluate them. what do I like to look at? I like to look at things like, first of all, I think to be a good technician, you're supposed to be a historian, right? And that means plotting, understanding what the market narratives are, and then going back and looking at fundamental charts to try and verify or invalidate uh, those those narratives. But I like to look at things like, and again, remember, I'm a rates guy. There are things that you can do for equity too, but like the slope of the ISM. What are the surprise? What's the slope of the surprise indices? Uh, what are what are LEIs doing? What's long-term employment doing? How does that relate to the business cycle? So I like to use fairly broad uh, things when I'm doing this. But again, I think just sitting back and like reading the Wall Street or whatever, have an opinion about the Fed, those kinds of things. It's hard. It's taken me years and years. So I have a definite Fed opinion. But look, the shorter term you trade, the less those things matter. It's only if you're trading on weekly, monthly, quarterly, trying to catch long-term trends where I think those things are very important. But that said, I spent a lot of time doing them. So, you know, things that are very like uh, coincident with the business cycle and have high correlation to uh, the price path of the asset, like in fixed income. If the ISM is strengthening, rates are probably going to rise, right? And for that cycle, that's a fairly short-term thing. Uh, you know, uh, the yield curve right now is highly inverted. That's uh, inevitably that creates a recession. But then you get into the problem of timing, right? And the other thing, if you look back as a historian, you figure out that what happens is the recession's beginning when the yield curve starts re-steepening, right? Same with uh, jobless claims, things like that. So, yeah, fundamentals, there's a big, wide palette. I like to take everything, boil it down to the like what's copper's momentum, what's that telling you about the business cycle, and where does that fit in that momentum style that I wrote the piece on earlier this year. And then I have a whole just ton of shorter term stuff. Again, slope of the ISM, claims, just kind of on and on. Slope of LEI, things like that.
Got it. So you really keep your eye on the macro environment, and that gives you sort of that foundation for what's is the economy strong? Is the market strong? That'll ultimately tell us what rates might do.
Yeah,
That's
and
a
it
great
just
lesson,
understand
actually.
fundamentals. They're it's like the narrative around recession's imminent that's been there. Well, that's fine. Yeah, if we just look at if we I don't even know how to explain it. It can be months and months and months before we finally see a recession. You see these simple narratives, and markets they're just not simple, right? It also ignores years and years of equity evaluation and home price evaluation, you know, years of fiscal and monetary stimulus that, to me, the market right now, I just think it's an artifact of mostly the fiscal stimulus that was uh, put in place after the pandemic, right? That's still being worked through and has given consumers 70% of the economy a pretty big cushion. But, I'm very attentive to things like when the yield curve finally begins to go move from inverted to steepening again, big moves in claims steeper, hooks lower, like the unemployment rate, hooked higher by 3/10 I'll be really interested to see. But again, those are just to build like this broad framework. And then I think, the fundamental is why to buy, but the technical gives you when to buy. And it also lets you know when you're wrong, right? I buy something based on some fundamental I'll be able to tell pretty quickly by watching the chart if I'm wrong about that. Because what's the old saying? Markets can remain irrational longer than you and I can stay solvent, and that's really the truth. And I like simple things. Look, I just like trend lines, horizontal resistance, Fibonacci objectives and retracements, and looking for confluences, and hopefully at a confluence, the market's either overbought or oversold, and then I can hone in, watch the bar chart, and hopefully pick off a trade or two as that happens.
So how about the aspect, and there are just a few more questions here, and I even have two that I wanted to ask you as well. And actually, before I ask you my questions, because I've already there are a few more in the chat, and these are interesting because some of our members have heard you mention rates a few times and the macro look that you have. And there's actually a few questions in here about gold. And I think rather than answering, whether you think gold is going up or down, I think would be interesting to hear is how do you think about gold in terms of, do you use it mostly as a barometer, maybe of what's trending in the market, or do you actually use it as a play to invest long term? Maybe it's a directional bet. Tell us about your views on gold and what you think of gold in general in the framework of sort of the entire market.
Yeah, I think gold is a trade, much like I do crypto. Look, the wrap around gold for years is it's an inflation hedge, right? And sometimes it is. you know Energy, it's an inflation hedge. Well, sometimes it is, but every inflation is different, and I don't think gold consistently has provided a store of value. So I'm not as sold on gold as anything other than just a trade, and perhaps looking at gold copper ratio, seeing which way that ratio is, uh, headed, to give me another hint about economic strength and weakness. Um, does that kind of answer you? It's a trade, and I think recently, it put in a couple of decent reversal bars and such. Uh, I had some gold as a trade. I closed it out. I'm flat, which brings me to another point. There, people forget there are three positions in any tradable, right? You can be long, you can be short, and flat is a position, right? It's just saying I don't have a great opinion right now. So, but gold isn't always a great hedge. Sometimes it is. It's like anything else. You got to buy it right. You got to buy it cheap for it to be a hedge, and then really it's just boils down to being a trade.
I love the aspect of, you have three choices in markets: buy, sell, or do nothing. And I actually heard a
Right.
great line about that recently where someone said to me that you could buy, sell, or do nothing. But what a lot of people don't know is 99% of the time, doing nothing is the better decision of all three, which I thought was so interesting. It was kind of illuminating. Like, that's right. Just be, you don't have to always be executing a trade or forcing a trade. Like, just do nothing till that perfect moment comes, arises. So I thought that was a great comment you brought up, and you had me thinking of that quote that I heard
I was
recently.
I was constrained for a long time because all I traded were bond futures, right, and bonds in general, but particularly bond futures, and that's where most of my research that I sold was centered. And I always just thought, oh my God, how easy would this business be if you're unconstrained, right? And you can look across several thousand equities, right? You can look globally now. You can find a fat pitch, assuming that the liquidity there is to support the trade. There's always a fat pitch someplace, right? So, if you're just focusing on one or two markets, that's one of the beauties of technical analysis, right? I can look across 100 charts, 100 day or weekly charts in 10 minutes. So I can find the fat pitch. And why would you take any pitch that's not fat?
I think that also I am enjoying how you continue to bring up that perspective of how much the landscape has changed for investing and trading, in a lot of people, including myself, who didn't have to install a satellite in their backyard like you did, or hand draw charts at certain points in time like you did, forget just how far we've come in terms of being able to access global markets. And you're right, now that we can see so many symbols, so many assets, we can look globally into different markets, there is always a fat pitch somewhere, so that actually should reduce people's impatient attitude. Or perhaps there's really no need to always focus or get married to one symbol, because now there is so much access to data. If you look hard enough, you're going to be able to find a fat pitch somewhere. So very interesting. And for those who don't know what a fat pitch is, it essentially refers to a phrase in baseball where let's say the pitcher goes down 3-0 in the count, or the pitcher is forced to throw up a pitch that can be hit really hard, really easily, a home run, and as a batter you're just waiting and waiting for this big juicy pitch right down the middle. And that's a sort of an investing comment as well. I have a few more. Yeah, I'll let you comment on
the
that.
other point I would make just in that regard, and like, how technology has changed trading. And I started making this point 20 years ago, and it's even more so now. But trends that used to take months to develop morphed into weeks, weeks into days, days into hours, and now the time it takes for people to catch on, get invested, it's just shortened the perspective of all of this stuff dramatically. So anyway,
That's actually so interesting. So and I want to ask this next member's question, but really quick, because technology has made it easier for people to access markets, thus bringing in more people, more money, more transactions. The length of trends has shortened. It's happening quicker.
yeah,
Wow.
yeah, and certainly the ability to get in near the point of maximum, you know, uh, you know, what's the word I'm looking for? You're looking for those points where there's likely to be change. I'm not a big trend follower, although that is a big part of institutional investing. Um, I really like to find those points where, my upside is big and my risk to my stop is fairly small. The points of maximum danger, or maximum advantage as it may be. Um, and those certainly hang around a lot less. There's a lot less time as those things develop than there used to be.
Well, we have another great question here, and this next question is, how can a trader know if an institution is accumulating a specific asset? And I actually don't know either. I don't know if there's a real way to know, but do you have any commentary on that? How you could potentially try to follow what the smart money or big money is doing?
Again, in equities, I'm not sure because it's never been a large part of my thing. I think Martha Stokes, who publishes on the platform.
She's on TradingView, Martha Stokes.
Yeah,
Yeah.
yeah, you can follow her, and I think she probably does a pretty good job of that. But really, it's more about volume. I use commitment when I'm trading futures a lot. I like to watch the commitment of traders, information that's generated. I think it has been particularly useful in the bond market for a long number of years for me. Um, but in terms of, so many of the trades now are done off book, you know, in the black market, basically. Um, I think it's much, much harder, but I would look for particularly volume in a narrow range. I think would be the number one thing I would look for in an equity, right? If I see a very narrow range bar with a lot of volume there and it's close to the low of the range or high of the range, I'm going to think that's probably strong hands or institutions that are working. But I would really look for Martha's work because I know she does a ton on that. Look, I try and I think 20% of your effort reading the bar chart gets you about 80% there, and whatever you want to do in markets, learn to read the bar chart. You're almost there. That other 20%, it's just details, whether it's oscillators or Elliott wave or whatever. It's read the bar chart.
And how about, and we'll wrap up here because we're nearing that hour marker. And I think there are two key points for us to dive into before we wrap up the show. And the first point is, having worked in an institutional landscape, having started your own research firm and that firm get acquired, having coached traders, having traded on your own, are there any traits that come to mind that you think are essential to being a trader that can survive over many years? Maybe one, two, or three traits that immediately come to mind?
Well, I think huge egos. If you've got a huge ego, it's really hard to admit that you're wrong. And admitting that you're wrong quite often is, I think, kind of essential. You know, being even keel, win, lose, draw. I think is having the ability to do that. A lot of people aren't. You're just not constitutionally set up to do that. And again, you live and die by the tick. For me, particularly when I was short-term trading, that was really, really difficult. Um, the ability to be decisive when you need to be decisive, um, not worrying too much. And look, one of the things I used to talk to my PMs and traders is just getting trapped in a narrative, right? You've got to have the ability. If you've got a big ego, the minute you express an opinion about any market, right? You've created this narrative, and you've created, just by sharing it with others, this it sets up all these psychological behavioral issues in what you're doing, right? You've got to develop your own personal defenses, so that you've got to understand you're one of those two guys every day, right? And one of them's wrong about stuff all the time. So you got to be willing to embrace being wrong, and you've got to be resilient too. Because look, I mean, I've had a couple of times in my career where, I had the one time I told you about earlier, where I just couldn't buy a trade for a long time. But I've had some trades go horribly wrong, and sometimes in some trades, because they're not in liquid markets, you can't. You could try and design a hedge using another market, but you can't just easily shut them down. And you've just got to resign yourself, and you've got to be able to, when those things go wrong, try to learn from them, because this is a process, and you've got to have the ability to move on and do the next trade, right? So, which also implies a consistency to your methodology, right? So that you're doing kind of the same thing over and over and over again, and following the same group of processes and that kind
Fantastic. So humility, number one, persistence, number two, and having a process.
of thing.
Makes perfect sense to me. Love that. Okay, so um, before we head out of here now, one topic that I did notice that was buzzing because of your background in the institutional space is just so, as it's captivating to a lot of people, and especially starting your own firm as well. Is there any parting advice that you would give the entrepreneurs in the trading and investing space who are potentially trying to build their own research firm or institution, or big fund, into the future? Is there any advice for those investing and trading entrepreneurs that you would give?
Well, since again, it's gotten more difficult, but be consistent, learn to communicate. I just read research that's good but communicated poorly is never going to cut through the fog on the institutional side. Um, and I'm not just a shill for the CMT. I mean, I've been a member for a long time. I think the CMT, because it is the association is more for institutional style traders. Um, I think being a member, getting your CMT, it's not very expensive as these things go, like compared to CFA, but it's going to put you in contact with a lot of people that have those good seats in these institutions, and they're going to be able to tell you more, and particularly if you're interested in equity. That's where about 90% of the people are interested. But I think that would be it. Learn to communicate. Oh my God, some of the stuff I read is just so bad. Um, and I get it. Some of you are English as a second language, which makes it even harder, right? But keep your writing fairly formal, and you got to do everything you can, at least if you want to be selling products in the English speaking world. Um, the more you work on your communication, the better. Um, yeah. What else?
I think that's actually a great way to end it because we just crossed an hour, and I think we ended with two super important points, which I find very helpful for myself, which was the three traits that you found among great traders. And then for those entrepreneurs in this space, in the trading and investing world, the element of communication and being able to write clearly. And actually, I find that pretty cool to hear because I don't hear that a lot, but you're exactly right. If you're going to survive in this space, you need people's attention. You need to get people to understand your ideas and concepts quickly, or maybe even your track record. Maybe you have a great track record. Well, you have to be able to communicate that crisply and clearly without any sort of doubt or maybe people misunderstanding what that track record is. So,
Which would
it's
bring
so
me to
important.
one final point.
Yeah, yeah.
Like these, when you've got people out here trying to sell you methodology or trading signals or whatever, you know, you don't need to see a track record. You need to see their P&L from an accredited broker, dealer, or exchange, because it's 95%, it's just BS, right? Um, I watched it for 45 years now, basically. And anyway, sorry, Steve.
No, no, that is it's such an important comment because it is, in the same way we talk about data being more accessible, you can get more charts, build watch lists, assets and indices from around the world. You're exactly right, though. At the same time, people can fake a lot of performance as well. So I actually think that's a very important note. People should be able to show true, very real, P&Ls from a brokerage that has all of its licenses and is regulated in a proper way. Like that's a ground truth. Like that has to happen for you to have any chance as well. Would you agree with that? That's what you're saying, right?
Yes. All right.
Stewart, thank you so much
Thanks,
for
guys.
this chat, and for those listening on our podcast, thanks for tuning in. You can also watch it on YouTube and TradingView live streams. So, Stewart, we'll be seeing you around TradingView, and thanks again.
See you guys.
See ya.